So what is equity funding? It's the process of raising money for your company where you're selling off ownership portions of the company. To understand this better, let's look at some corporate finance basics and capital structure basics. The balance sheet is one of the three financial statements of a company, along with the income statement and statement of cash flow. The income statement is also called the statement of profit and loss, or P&L. You can derive the statement of cash flow from the company's balance sheet and its income statement. The balance sheet shows the financial status of a company as a snapshot on a particular day. On one side of the balance sheet, it shows all the company's assets that can be quantified in monetary terms. On the other side of the balance sheet, it shows the combination of the company's liabilities plus equity. This is also known as the company's capital structure. The capital structure shows the combination of liabilities and equity that was used to finance the company. In a balance sheet, the equity value is derived. In other words, equity is equal to assets minus liabilities. This is something known as the book value of the company. That number may have very little bearing on the actual market value of a company. The market value is the price for a share of stock in a company times the number of shares issued and outstanding. I recently wrote a blog post about company valuation where I talked primarily about private company valuation. As I said in that post, your company is worth exactly the amount someone is willing to pay for it, as quantified by the price per share of stock times the number of shares. With that background, let's shift gears a bit and look back at its capital structure. There are two ways to raise money for a company: debt, which is part of the liabilities, and equity. Most people think of debt as a loan, and that's exactly what debt is. A loan a company takes is similar to a loan you would take as an individual. You borrow money, promise to pay it back, and pay an interest rate plus principal for the term of the loan. In the case of corporations, they can borrow from individuals, from banks, or from other institutions. Corporate debt may have other features besides interest rate and term, but those are the two most important terms unless it's convertible debt. Convertible debt has another provision that allows the debt to be converted into equity at some preset price. That price can be set as a monetary amount or derived from a future price of equity that is sold, usually at some percentage discount to the price of the equity being sold. In the event that all the company's assets are sold for an amount less than the value of the liabilities get paid first before any equity holders get paid. This is called the preference stack, and I'll show a generic capital structure from Axial Forum. So what about equity? Equity, according to Investopia, is a stock or any other security representing an ownership interest. This may be in a private company, which is not publicly traded, or in which case it's called private equity, or in a publicly traded company. Just like there are multiple types of debt, there are different types of equity. The two basic types of equity in a company are preferred stock and common stock. Preferred equity is a class of financing representing ownership interest in a company, as opposed to fixed income assets like debt. Equity is a so-called variable return asset. However, preferred equity has both debt and equity characteristics in the form of a fixed dividend, like debt, and future earnings potential, like equity. Correspondingly, it gives the holders upside and downside exposure. Its claims on the company's assets and profits come behind the debt holders and ahead of the common stockholders in the preference stack. This is actually the most important feature of preferred stock in a privately held company, along with the conversion provisions. In a private company financing, outside equity financing is almost always raised as preferred stock. Generally, preferred equity obligates management to pay its holders a predetermined dividend before paying dividends to common shareholders. On the flip side, preferred equity typically comes without voting rights. However, this is typically not the case in a private company financing. And doing a private company financing is critically important to understand valuation, conversion terms, and all the other deal terms. In fact, the deal terms are sometimes just as important or even more important than valuation. Common equity is also a class of financing representing ownership interest. Common equity is the junior-most block of capital structure in the preference stack, and therefore represents ownership in a business after all the other obligations have been paid off. For this reason, it comes with the highest risk and the highest potential return of any tier in the capital structure. If you're raising private capital, it is called a private placement. If you're raising money in the public markets, it's called a public offering. The first time you sell company stock in the public markets, it's called an initial public offering, or IPO. That's pretty much the basics of capital structure. So how do you go about raising capital for your startup? Well, you can raise capital using the various forms of debt, or you can raise equity capital, typically in the form of private placement or preferred stock in the company. So what are the sources of equity financing for a company? Typically, before you raise any outside money, there's a bootstrapping phase where a founder will use his or her own money and take personal loans. They may also raise money from friends and family, usually in the form of convertible debt. At the seed stage of fundraising, companies usually look at individual angel investors and sometimes wealthy families called home offices. These same sources, along with so-called super angels, can also be involved heavily in Series A financing rounds. Venture capitalists typically don't get involved in a company financing at least until a Series A, and sometimes even later. A relatively new way to raise private equity financing is called crowdfunding, and it's available in the US via what's called the Jobs Act. The best way to raise outside capital for your startup is to build a target list of prospective investors that have technical and domain expertise in your target vertical markets, and then work that list. You want to get so-called smart money investors into your deal at a fair valuation with the right deal terms. The process of defining your list is something I discuss frequently in my blog post. Well, I hope you found this information valuable. If you have, please sign up for my monthly newsletter via the QuestFusion website. I offer insights, tips, and tricks in the newsletter that you won't want to miss. This is Patrick Henry, the CEO of QuestFusion, with the real deal, what matters.